Today is April 14, 2026. Tesla is sitting at exactly $352.42. So I have to ask you, is this stock in a fatal falling trend, just flashing, glaring sell signals everywhere? Or, is it a wildly undervalued strong buy that's just hidden in plain sight?
Oh man, it is the ultimate Rorschach test for investors right now. I mean, when you look at the data today, what you see says a lot more about what you believe the future holds than, well, what the company's actually building right now.
Yeah, totally. And that's exactly what our deep dive is about today. We're going to unpack this massive stack of current financials, dark pool order flows, and some really granular technical data to figure out if Tesla is a generational wealth builder or just a devastating value trap.
And we really need to look at both sides because the division in the market is just staggering. You essentially have two completely different tribes screaming at each other over the exact same ticker symbol.
Right, but hey, real quick, before we get into the data and see where the smart money's hiding, we need you to like the video, subscribe to our YouTube channel, and honestly, it is absolutely compulsory that you leave your feedback in the comments. We want to know where you stand.
Yeah, please let us know. Are you buying or bailing?
Exactly. So, okay, the best way I can describe Tesla right now is imagine a legendary rock band, right? And they decide to switch genres right in the middle of a massive stadium concert.
Oh, that's a great way to put it.
Yeah, like they just put down the electric guitars, pull out a bunch of synthesizers, and suddenly half the stadium is walking out in absolute frustration.
While the other half is, standing there completely convinced they're witnessing music history.
Exactly.
It perfectly captures the tension because Tesla is undergoing this painful, incredibly complex transition. They are pivoting away from being just a pure play automotive manufacturer into what they're calling a physical AI company.
Right.
And when you look at the financials, you can literally see this massive tug of war playing out in the numbers.
Okay, well, let's look at those numbers. Because before we debate robots and AI, we have to look at the cold, hard cash reality of the present. Let's pull up the scoreboard.
Let's do it.
So current price is $352.42. But over the last 52 weeks, this thing has been bouncing between a low of $222.79 and a high of $498.83.
That is a massive spread. I mean, a 52-week range that wide for a mega cap company tells you the broader market genuinely just does not know how to price this asset.
No idea at all. And looking at the trailing 12 months income statement, you kind of see why they're confused. Total revenue is massive, $94.83 billion.
Right.
But the core auto business, the actual cars, is shrinking. It's down 6% year over year.
Yeah, which means you have to look at where the growth actually is. Energy is up a staggering 67%, and services are up 27%.
Wait, hold on. 67% for energy. We're not just talking about the batteries inside the cars, right?
Oh, no. We are talking about massive utility-scale infrastructure. Megapacks.
Oh, wow.
Yeah, these are the size of shipping containers that plug straight into the electrical grid. That division is quietly becoming an absolute powerhouse. But, everyone is so distracted by the car sales.
Sure, because cars are still the brand, and losing ground there is hurting them. Net income took a massive hit. It cratered down to $3.8 billion.
Down from what, almost $15 billion in 2023?
Exactly, from $14.9 billion to $3.8. And gross margins are squeezed down to 18.03%. Basically because they've had to heavily slash prices on the whole S3XY vehicle lineup.
It's the classic margin squeeze. You cut prices so you don't lose market share to competitors, but your profitability just falls off a cliff.
And EPS, earnings per share, is sitting at just $1.08. But then you flip over to the balance sheet, and it's a completely different story.
Yeah. The balance sheet is a fortress right now.
It really is. They have $16.51 billion in raw cash. And if you include all their investments, it's $44.1 billion.
With a very healthy current ratio too, right?
Yeah, 2.16. And leverage is crazy low. Debt to equity is just 10.20%.
Which is their superpower right now. Because if they had a ton of debt during this messy transition, they'd be dead in the water. That low leverage buys them time.
Okay, but does it? Because I'm looking at the cash flow, and operating cash flow is $14.7 billion, but free cash flow just dropped significantly to $6.2 billion.
Right.
So as an investor, if I'm looking at a shrinking auto business and dropping cash flow, I mean, shouldn't I be running for the hills?
It's a completely fair question, but you have to look at why that free cash flow dropped. It's not because they're bleeding money on operations. It's because they spent a staggering $11.3 billion in CapEx.
11.3 billion just on capital expenditures.
Yes, specifically on AI infrastructure. Supercomputers, neural networks for self-driving, the robots. They are basically telling the market, hey, we'll trade short-term automotive margins today to guarantee long-term AI dominance tomorrow.
So it's a massive calculated bet.
Exactly.
Okay, so the financials show them spending billions to pivot, which explains why the stock is down from the $500 highs. But that brings up the real question. Who is actually buying and selling at 352 right now?
This is where the data gets wild.
Because there is a shocking divergence between insiders and the institutional smart money. Let's look at the insiders first. Director Kathleen Wilson-Thompson just made 15 sales, totaling about $9.3 million in late March.
Yeah.
And Officer Vaibhav Taneja is also selling. In total, insiders dumped over 53,000 shares in the last 3 months.
Which naturally freaks retail investors outright.
Yeah.
Like, if the people running the company are selling, the ship must be sinking.
Right. But then you look at the smart money, and they are doing the exact opposite. We're seeing major dark pool buy premium spikes. Institutions are desperately trying to build this liquidity floor.
Yeah, the whale activity is hyper-concentrated right now.
Very concentrated, specifically at the 340 and 350 option strike prices. And just a few days ago, on April 9th, a massive power inflow buy signal triggered at $338.65, and it just sucked in heavy volume.
So let's unpack this. A dark pool is just a private exchange where big institutions trade massive blocks of stock without spooking the public markets.
Right.
When you see a power inflow trigger there, it means serious Wall Street capital is stepping up.
Okay, but help me out here. If the people actually running the company are selling thousands of shares, why are the Wall Street whales quietly backing up the truck to buy?
Well, it comes down to the psychology of order flow. Insiders sell for a million different reasons. You know, they might be diversifying their personal risk, or maybe they just have a huge tax bill to pay.
Okay, that makes sense.
But institutions, they are looking at that $338 level as the absolute foundational floor for this whole new AI narrative. They only buy because they think it's going up.
Okay, so we know where the whales are hiding. But what does the actual chart tell us about the stock's momentum? Because there's been some serious short-term weakness.
Yeah, the technical setup is showing some stabilization after a really rough patch, but it's still precarious.
Very precarious. The stock is actually trading below its major resistance levels right now. The 50-day simple moving average is at $399.50, and the 200-day SMA is at $378.70.
Trading below both of those is definitely a bearish signal for the longer term.
Yeah, and the MACD reflects that. The long-term MACD is at negative 1.05. But the daily MACD is actually showing a slight positive blip of plus 0.50.
Which means the immediate bleeding might have stopped, even if the overall trend is still down.
And the RSI, the momentum indicator, is just hovering right between 34.7 and 55.5. So it's in neutral territory, but it recently skirted the edge of being completely oversold.
Right, so we're just waiting for a catalyst to push it one way or the other.
And here's where it gets really tense. Crucial support is sitting between $332.57 and $337.
That level is everything.
It's like a tightrope with no safety net. If it closes below 332, the data says the next target is all the way down at $224.16.
Oh, man.
I mean, that's a terrifying drop for anyone holding the bag right now. Major resistance above is that gap fill area between 370 and 382.
And that technical knife's edge perfectly mirrors the chaotic debate among professional analysts. Like, is this a true bargain or just the ultimate value trap?
The debate is insane. Listen to these ratings. 48% say buy or strong buy. 30% say hold. And 22% say sell or strong sell.
That is completely split down the middle.
Totally split. The median price target is $394.71. But the extremes are wild. You've got a high target of $600.
Wow.
And a low target of just $115 from JP Morgan.
A low of 115, that's brutal.
Right. And look at the valuation models. Guru Focus GF Value prices it at $254.25, basically declaring the stock about 38% overvalued.
Okay, but what about the bulls?
Well, Treffy's argues fair value is $588.18, but that is entirely based on future robotaxi and AI revenue.
Yeah.
So how can the supposed smartest people in the room be this far apart? I mean, a $115 target versus 600 doesn't just sound like a difference of opinion. It sounds like they're evaluating two completely different companies.
Because they actually are. They really are evaluating two different companies at this point.
What do you mean?
Well, the bears, the ones calling for 115, they are pricing a struggling car company. They see shrinking auto revenues and squeezed margins, but the bulls, the ones targeting 600, they are pricing a revolutionary robotics and AI firm.
Ah, okay. So since the bears are pricing a struggling car company, let's examine the worst-case scenario. What are the specific downside risks that could actually make this stock plummet to those lower levels?
First off, you have the classic retail trap.
Right. Why do everyday retail traders get trapped here?
Because they buy the dip based on the old narrative. They remember Tesla as the undisputed EV king of 2020, completely ignoring the new volatility and how much the landscape has changed.
And the landscape is rough right now. There was a massive Q1 2026 delivery mess.
Huge miss.
Yeah, which created a record backlog of unsold EVs just sitting around. And in China, competition is brutal. I mean, Xiaomi's YU7 is currently significantly outselling the Model Y.
Yeah, let's pause on that. A smartphone company, Xiaomi, is suddenly beating Tesla at its own EV game in the world's biggest market.
It's totally jarring to hear that. A phone company is winning the car war. But there's also another wild card risk here, isn't there?
Oh, absolutely. The looming risk of a SpaceX IPO.
Right. If Elon Musk takes SpaceX public, it could heavily divert liquidity away from Tesla. Investors who just want exposure to Musk's innovation might jump ship to his shiny new rocket company.
Exactly. And if that happens and the whole physical AI pivot fails, the bearish models say the stock crashes straight to that $145 to $250 range.
Okay, but let's flip it. If the EV business is just the funding mechanism for the future, what does the best case recovery scenario look like?
The bull case is honestly pretty compelling.
Let's hear it.
Well, full self-driving and the robotaxi platform just got official approval in the Netherlands.
Oh, wow.
Yeah, which opens the floodgates for EU-wide software revenue. It proves the tech works overseas.
Plus, the Optimus Gen 3 robot is expected to be revealed in Q1 2026, right?
Exactly. Combine that robot reveal with the explosive 67% growth in energy storage we talked about earlier, and it proves the non-EV growth engines are actually firing.
So the strategy's working. What's the short-term outlook then?
Short term, over the next few days or weeks, expect heavy consolidation between $335 and $360. The stock absolutely must break above $370 to confirm a reversal before the critical April 22nd earnings report.
And long-term?
Long term, it all rides on mass production of Optimus and robotaxis. Success justifies the current massive valuation. Failure means a brutal correction.
It's crazy. Here is where it gets really interesting for you as a listener. Tesla's biggest engines for future growth right now don't even have four wheels.
Nope. Software, batteries, and robots.
Yeah. Now, before we go, we have to remind everyone that this deep dive is just an exploration of data and human debate. It is absolutely not financial advice.
Right. Please do your own research. We're just looking at the numbers.
Exactly. But we are looking at a company at a profound crossroads, sitting right at a major technical support level, with insiders selling, while Wall Street whales are buying in the dark pools.
It's the ultimate standoff.
It really is. So with earnings looming on April 22nd, here's the thought I want to leave you with. What happens if the grand physical AI narrative hits a delay, right at the exact moment the harsh reality of unsold EVs and Chinese competition bites the balance sheet?
It's the million-dollar question.
Are we witnessing the awkward adolescence of an AI titan, or just the slow unwinding of an automotive bubble? We'll leave you to ponder that one.